The following presentation is brought to you as a courtesy from Forex Academy. This is part of our service, Live Beginner's Course. If you find it interesting and wish to be updated on new releases, please subscribe to our YouTube channel or join our community at forex.academy and receive all our services for free. Your like is also highly appreciated. Enjoy.
Traders often range trade these levels or look for breakout opportunities, just like previously expressed. An acknowledgement of such levels often cause a trading congestion around key Fibonacci levels. So let's look in more detail to how we can assess this. What we do in terms of the technical Fibonacci retracement, we will look at this in a lot more detail in the final lesson this week, final lesson number 8, which is a practical workshop. So do anticipate practically placing the Fibonacci with that lesson on our MT4 as we look for a long-term swing and high. So we pick these points here in the markets and we actually place the Fibonacci retracement across it. It creates a retracement support level as a function of the Fibonacci mathematics. Okay, so as a technical indicator, it works best over many different asset classes. So here we can see that the Fibonacci does go from left to right. It gives us those levels of support and resistance. And what we'll do is just assess it in a little more detail to assess what happens next at this price point. Well, as the market trades through, it is very aware of the Fibonacci retracement levels. So what we see is it is just another level of support and resistance. And what I'm going to do is just pick out a few levels here where it has adhered and given us a real level of support. So here we can see with these levels as well, we can see it bounce from our levels of support just at these areas here, just misses, but again reverses, and again just here. So let's just highlight these in a little more detail in terms of trading opportunity. What we can see are these are certain levels where we see bounces from our Fibonacci retracement and levels where we see the price break through to the upside. So as technical analysts looking at the market structure, we'll be trying to identify the Japanese candlesticks to give us the key information that we need to trade. It is the awareness of Fibonacci levels that the market often focuses on. I suppose one of the points I'd like to make, it often becomes a self-fulfilling prophecy. So just like placing these levels of support and resistance, there are technical traders that try and identify, simply what they do is identify market structure, technical market structure, so that we can trade a bounce off a support and level or any sort of resistance in the market where prices can't break through. And because there are so many traders looking to trade these levels, it often becomes a self-fulfilling prophecy that creates a level of purchasing power or buying at a certain level so that the market shifts away. The hypothetical question again is, what happens next? So what is more likely to happen if we get the market trading down to such a level and perhaps stalling? The market stalls at this level and creates this little structure. We're more likely to see this just as a technical market structure to trade to the upside, and that could be a profit target up to the new highs again. So always be aware as technical trading focuses in on market structure to these levels, and it can give you the best trading opportunities, of course, on that technical basis. Let's look at technical price charting. Now, this time before we go on to really discussing, I suppose, in theoretical explanation, what price charting is technically, let's observe it in the price charting first. Can you spot the effect of price consolidation on the market? So here we have the crude oil daily. Can you spot the effect of price consolidation? Just to ask and see some questions or some answers coming in. Yes, effectively it is creating a level of support and resistance at new highs to new low. So this is of course our resistance level or our floor. So we'll put this is effectively our ceiling here, just at this price now. Excuse my handwriting in there, is our ceiling at resistance, and we have so many points where the market effectively trades up to and bounces off this level, giving us short trades. You can see with the candlestick structure there, we cannot get any consistent trading above it. So that is effectively our new ceiling, and we have effectively our new floor with 1, 2, 3, potentially 3, and then we have another trading opportunity from this one particular level of consolidation. Now, what does that mean? Well, it simply means that the market has traded up to that level, and we've seen a bullish move up. And this is generally what happens in terms of market structure. We see prices move in one direction. As that movement relaxes, it can trade a range, and we see this horizontal price movement from left to right. Now, many traders do like to trade these conditions to simply buy and sell the lows and highs, and then try and trade the breakout if this eventually fails, which we see then with our fourth point. We see the breakout to the downside again. So effectively, what is the effect of price consolidation? Well, the trading range is the effect, the level of congestion is the effect, and those opportunities really are the cause and effect of this horizontal or sidewards movement in the market. Again, the market structure is detailed. We've had a strong move to the upside, and now we're seeing a relaxed period of opportunity. Here we see the consolidation, and then B is of course our breakout. And again, we can see the market structure gives us a little inclination, which we'll deliberate just across in the next few slides. We see a price channel here starting to form, and again, just like our support and resistance, we can see something much more creative in this support and resistance here. So again, all of these factor into all of these different asset classes. Previously, we were looking at a currency pair with the US dollar yen. We're now looking at the oil. We can see some very consistent levels of support and resistance in this market, and then some channels to actually looking to break out and trade other opportunities. So let's just recap on really what this means to us as traders. Well, price consolidation, it relates to price congestion in the marketplace. Okay, so traffic, if we think of a traffic jam on the road, that is what we look to see price consolidation in market structure. Consolidation is often around well-identified levels in the markets. It often creates order stuffing, just like the traffic jam, in institutional trading and range trading in retail trading. And that, of course, is opportunistic, guys. We can often make, very short-term trades, maybe a plethora of them, 4 or 5 different trades at the same level, which can all be profitable. And then evidently, when there's a breakout trade, we can either try to trade that breakout to the side, or for still range trading, and we'll evidently take a loser. But hopefully, the fact is that we can trade the range more significantly to actually profit over the long term. The longer the price consolidates, the higher the probability of a breakout opportunity, and the stop loss inevitability effect is what, of course, can cause the breakout. So this order stuffing creates a lot of buying and selling both in and around the ranges of the market. When that breaks down, we can see all of these stop losses go off and causing a breakout to one particular side. So it does provide many different effective trading opportunities both during the level of price consolidation and after, and that is of key importance to trade these market structures.